So options can be a very versatile and flexible tool in an investor's toolkit. We've discussed in the past how options can be used to speculate on the direction of a stock. We've also talked about how options can be used to generate income. In today's session, we're going to talk about how options can be used to hedge and protect your portfolio. We're lucky to have Richard Ho, the head of retail equity derivatives with the Montréal Exchange, here with us today. He's going to walk us through two very useful strategies. First, we'll discuss how to employ a protective put, and then we're going to take that strategy one step further, and we're going to introduce you to the collar strategy. So without further ado, I'd like to welcome Richard Ho. Richard, I appreciate you being here. Thanks so much. How are you doing today?
I'm doing great, Jason. Thanks for having me.
Great, perfect. I know before we start, you've got a disclosure that you'd like to cover.
That's right, Jason. The presentation is for educational purposes only and should not be construed as recommendation or investment advice.
Great, thank you. So before we jump into the presentation, maybe it would be worthwhile for you to do a quick recap on options covering their obligations and their rights.
Sure thing, Jason. In the options market, there are two option types, calls and puts, and they are traded between buyers and sellers, also known as writers, if they are selling an option to create a new position. When you buy a call option, you have the right to buy the underlying stock at the strike price before the option expires. The option writer has the obligation to sell the underlying stock at the strike price before the option expires. Now, when you buy a put option, you have the right to sell the underlying stock at the strike price before the option expires. The put option writer has the obligation to purchase or buy the underlying stock at the strike price before the option expires. Now, in an options transaction, there is an exchange of money that we call the option premium. And this option premium is paid from the option buyer to the option writer. So that's a quick recap of Options 101.
Perfect. Thank you, Richard. So we're here to learn about protecting your portfolio from risk. Can you go over some of the types of investment risk that we may face as investors in the market?
Sure thing, Jason. Now, as an investor, there's always risk that you could lose money, and everyone is hoping to make a profit. The key is to recognize the risk involved with your investment, understand it, and decide whether or not that is a risk that you are comfortable with. Every investor has a different risk tolerance. To be comfortable with your investments, you should think about your risk tolerance level before you invest. Here on the screen, there are 4 risks. By no means this is an exhaustive list of investment risk. There are common ones such as market risk, where change in a specific sector related to your stock could be impacted. There's also currency risk. This occurs when investors trade in foreign markets, which exposes you to FX risk. Equity risk is risk that investors take on in exchange for a potential price appreciation. Now, last but not least, there's also headline risk. These are stories or headline news in the media that can impact the business or even the entire market. So these are the risks that investors need to be aware of.
Great, thank you. So as we know that risk is involved with any investment that we make, how can we reduce those risks that we face?
Let's use, the most common day-to-day application of risk transfer is from our, for example, home, auto, and life insurance, where party A cannot afford to bear the risk of losing their assets. Therefore, party A will transfer the risk to party B, who can absorb the risk and impact. Now, in exchange, okay, party A will need to pay party B a premium for taking on that unwanted risk. As a stock investor, you can also mitigate any risk that you do not want to bear by using options. And this is what we're going to talk about today, how you can purchase insurance on your stock positions by using options.
Stock insurance sounds like a very intriguing idea. How would that work, Richard?
Well, Jason, stock insurance is indeed an interesting concept. Let me show you our first hedging strategy. The name is protective put. For example, if you buy a stock when it was trading at $41, A few weeks later, the stock goes up to $45, and you think that it still has potential in going over 10% higher. So a few weeks go by and the stock drops, but you insist on holding it. Now, luckily, it goes back up to $45 and it looks like it's hitting a resistance level, but you're adamant that it can go even higher. But by doing so, you're faced with future unknown risk. Now, this is where you need to pause and evaluate what is your motivation. Do you want to secure your unrealized profit? Is this a stock position representing a substantial percentage concentration of your portfolio? How important is it to preserve your capital? Are you nervous about the stock's near term performance? And how long do you need this protection for? Now, these are the questions that you need to ask. If you ask different investors, Jason, you're going to obtain different answers because no single investor has the same risk tolerance and investment objectives.
That's true. So with that in mind, could you walk us through an example on how we would set up a protective put?
Absolutely, Jason. Now, when an investor wants to set up a protective put or stock insurance, you have to have a bullish outlook with short term concerns on the company. Because when you purchase any type of insurance, it's going to cost you money. By buying that insurance, it gives you a peace of mind and also the ability to sleep better at night. The setup is simple. Depending on the number of shares that you hold, you need to buy put options to cover the stock position with a ratio of 1 to 100. Now, in our example, let's call our investor Sophia. She has an unrealized gain of $4 per share. Now, in order to lock in the gains, she needs to purchase a put option because it'll give her the right to sell her shares at the strike price, no matter what happens to the stock price. And this still leaves her with unlimited upside.
Now, I know this is a question we get all the time from our investors, but how would Sophia choose a strike price and an expiration date?
Well, Jason, the answer will vary from investor to investor because the adjusted cost base will be different if you ask that question amongst different investors on the same stock. But one thing for sure is the higher the strike price of the put option, the more expensive the insurance cost will be. Now, the other thing is the expiry. The more time the option has, the more expensive it will be. In this table, we have a $45 stock and put options with strike prices varying from $38 to $46 that expire in 50 and 60 days. Whenever you buy stock insurance, you can easily calculate your maximum risk. Now take a look at the third column and simply take the strike price minus the stock purchase price minus the cost of the put option. The strike price, remember, this is your guaranteed selling price because whenever you purchase a put option, you have the right to sell the underlying stock at the strike price. Now, for example, if the stock price or the stock purchase price is $41 and that you're guaranteed to sell your stock at $46, which is the strike price, you have secured a gain of $5 per share. And depending on the expiry of the option that you select, 50 or 60 days, this will reduce your guaranteed gain because the 60-day insurance will cost you more premium. The flip side of this trade is that you have unlimited upside. If the stock keeps on rising, you won't need your stock insurance and simply you can let it expire or you can unwind the option position and recuperate any remaining time value.
Great. And can you show us some other potential outcomes that would, or give us some examples of the outcomes with this particular trade?
Sure thing, Jason. Now let's go over this example and let's review what happened in the future. Just to recap, Sophia, our investor, She bought the stock at $41. That's her entry point. Once the stock reached $45, she buys a put option to insure her stock because she is long term bullish but has near term concerns. Now, guess what? She was right because in January, the stock dropped to $36, huge market sell off. Now, Sophia can do two things. One is to exercise the put option to sell her shares at the strike price, or two is to close the put options at a profit and use the profit to offset the loss in the stock position, and she gets to keep the stock. Now, in this scenario, we know that Sophia had bought the stock for $41. Now, let's examine her situation with two extremes. I love using extremes because this is where you can see the difference by using a $38 strike price put option versus a $46 strike price option. Obviously, the $46 strike put option will cost more because it offers a greater protection than the $38 put. If the stock price drops to $36, the loss on the stock will be $5 per share. However, the profit on the option would be very different. Both options are in the money because the strike price are above the price of the stock. The $38 put option is in the money by $2. Now you may be wondering, how do I get the $2 value? If the $38 put option allows me to sell the stock at $38, which is the strike price, and the stock is now trading for $36, this means that the put option has a $2 intrinsic value, and that's how I get the $2 value. However, Sophia can still sell her put option for $2.20 because there is still some time value left before the option expires. Even if she takes the option profit, it won't offset completely the $5 loss on the stock because the $38 strike price is lower than her entry price of $41. Now let's take a look at the $46 strike put option. This option is deeper in the money. Therefore, it's going to have more intrinsic value. The $46 put option will worth at least $10. And the 10 cents difference is simply the time value because the option still has time before it expires. This option profit is greatly sufficient to offset and cover the $5 per share loss on the stock. Now, therefore, by using these two extreme strike prices, you can visually see what happens when the share price drops and also the effectiveness of the stock insurance based on these strike prices that you choose.
That's absolutely a very interesting example, seeing it from both sides of the spectrum. Now we want to obviously present a fair and balanced view of the protective put. Are there any potential downsides that we need to be aware of?
Yes, Jason. Now, the best way to describe the drawback of a protective put is to use a payoff diagram. So what you see here on the screen is a payoff diagram of a protective put strategy. The horizontal x-axis is the stock price, and the vertical y-axis is the overall position P&L, so profit and loss. As you can see in this payoff diagram, you have a floor. This floor is your maximum risk. So no matter how much the stock drops, your loss is limited. And if the stock goes up, you have an unlimited upside. Whenever you purchase stock insurance, it will increase your break-even point. This becomes an extra expense. Now, this can be perceived as a drawback, but for some, it can also be perceived as a benefit. It really depends on how you see the glass, half full or half empty.
That's true. So in speaking about expense, there is strategies that are available to investors that don't use options, namely using a stop loss order as protection. Why would an investor choose one strategy over another?
Jason, that's a great point, and I'm glad that you brought it up. because a stop loss is another good risk management tool to use. But in a volatile market, it might not be of much use because investors can get stopped out in the morning when the market opens, and the stock can rebound in the afternoon. But unfortunately, the stop loss order is already triggered and your shares are sold. But when you pay for stock insurance like a protective put, you are in the control seat because it is up to you to decide whether or not if you want to exercise the put option. Plus, you're guaranteed to sell your shares at the strike price that you select so that you have your guaranteed exit price. Now, in a volatile environment, the protective put option is whipsaw proof. So even if the market gaps down in the morning and then comes back up late in the morning, you still have time to decide whether or not you want to exercise your put option and get out of your stock position. So this is why investors would pick a protective put versus a stop loss. Obviously, a stop loss order is free, but there's no free lunch in the market. You get what you pay for.
Like, good analogy. So if an investor is settled on a protective put, is there a strategy that we can employ to offset the cost of the stock insurance that we've bought?
Absolutely, Jason. There are some strategies like that in the options market. And I'm pretty sure that some of our viewers are thinking about the same thing because we don't want to consistently pay for insurance. Otherwise, it's going to increase the cost and also break even point. So the way to offset the stock insurance costs, the strategy that investors could refer to is called a collar. Now, the objective is to limit the losses by using a put option to guarantee a selling price and also at the same time write a call option to subsidize the cost of the put option. However, by doing so, you will be capping your upside. This is what I mean. As you can see on the screen, you sell a call option and you purchase a put option for every 100 shares held. Now, the anchor position is the stock position. The stock acquisition will trigger a debit inside your trading account. Next, we add the stock insurance by buying a put option. The put option will give you the right to sell the stock at the strike price, so this will be our floor. And since we're buying a put option, we'll see a debit in the trading account. Lastly, you're going to sell a call option. When you sell a call option, you will be entitled to the option premium. By doing this, you will see a credit in your trading account. But since you're selling a call option, you also inherit the obligation to sell your shares at the strike price if ever you get assigned. So this is where you have a capped upside because of the call option that you sell. Now, the objective here with a collar is really to offset the debit that we see when we buy the put option for stock insurance. You are giving up the upside potential in exchange for a lower hedging cost.
Excellent. And to put it all together, can you walk us through an example of the collar strategy?
Sure. So let's use a $40 stock and you purchase 100 shares. At the same time, we purchase a put option with a $40 strike price for 60 days. Now, essentially, this means that no matter what happens to the stock price, you will have the right to get out at $40. But this protection will cost us $1.70 per share. Now, to offset the cost of this protection, we sell a call option. In this example, we're going to use a $42 strike call option. This means that our maximum gain is limited to $42. Now, even if the stock shoots up to $60, our capped upside is limited to $42, the strike price. But by selling this call option, we are receiving 85 cents per share. The 85 cents per share from the call premium is going to help us reduce the cost of the put option by 50%. Now, if we add all three positions together, we get a net cost of $40.85 per share. Underneath, you're going to see the difference between a collar and a protective put. A protective put will offer you an unlimited maximum gain, but the maximum loss is going to be higher. Whereas the collar will offer you a limited maximum gain, but a lower maximum loss. Therefore, here you can visually see your floor, your cap, and also your net costs. And that's really up to the investor to decide whether if he or she prefers a collar or a protective put.
Great. Great to see the extra flexibility that investors have. Now, in the example that you've presented to us here, Richard, you bought the stock and the put at the same time. Is there a difference for investors if they execute it in that way, or if they buy the put sometime in the future?
Jason, that's a great observation. The timing of when you buy the stock insurance will give the strategy a different name. If you acquire the stock insurance or protection at a later time, we call that a protective put. But if you buy the stock insurance at the same time as the stock, we call this a married put. At the end of the day, it's just a naming convention. Nothing is really different between the two strategies. You still get that stock insurance protection.
Great. Thank you for that, Richard. Well, this has been great. I really think this has been a very informative session. I've enjoyed you being able to shine a light on options and show them in a different perspective. Do you have any closing thoughts that you'd like to wrap up with before we throw it over to the Q&A?
Yeah, Jason, and that's absolutely right because many investors only think about the speculative side of things when it comes to options trading. But options also have a risk management side that very few investors think about. Now, whenever you want to acquire stock insurance or lock in any, unrealized capital gains, you should consider buying a put option. Now, by buying this put option, obviously it's going to come at a cost. So continuously hedging could reduce your gains. If you want to offset the hedging costs, you can consider using a collar strategy. Now, last but not least, a stop loss order is free, but it provides a lot less flexibility versus a protective put strategy.
Great. Once again, thank you very much, Richard. Over to the Q&A.
My pleasure.